This right here is the federal income tax code. This is over 2,000 pages long. And what it says is, this is what income is, these are what your deductions are, these are what your write-offs are. And I can tell you I have this because I went through law school, and what I can tell you as an attorney, who's not your attorney, is that real estate has some of the biggest and most powerful tax deductions and write-offs that our tax code has to offer. By the way, this book is over 2,000 pages long. Number one is because of the deductions you get, aka write-offs. Now, before you go and implement any of the things that I talk about, talk to an accountant in your area. This is not financial advice. You have to talk to an accountant because all these things are very heavily regulated. So you want to make sure that whatever you're doing is legal. You don't want to run into red flags or run into issues with the IRS. Number one, with deductions, when you invest in real estate, you are essentially starting a business, and your business is investing in real estate, and businesses get to write off some of their business expenses. What can some of these business expenses include? Well, if you're investing in real estate, you need a car to get to and from work. You can potentially write off a piece of your car, or the car value, or your lease, or your car payment. You need gas. You can write off some of your gas. You need a cell phone to operate your business. You can write off some of your cell phone. You might need meals. You can write off some of these meals. So there are many write-offs that you can use, deductions, because now you are investing in real estate, which lower your taxable income. See, for most people, when you're a W-2, when you're an employee, the way that your income statement looks is you make money, then you pay taxes, and then after you pay taxes, that's when you pay for your expenses. But when you own a business, or if you own real estate investments, now it's kind of flipped. Now what you do is you make money, and then you pay for your expenses. Now, of course, you can't write off things that aren't related to your business, but you have to be smart here, and your accountant's gonna work with you to see how you can write off the most things possible legally. That way now you can file more expenses legally. No, you pay these expenses, and then you pay taxes on whatever's left. That means now you have a lower taxable income. If you have a lower taxable income, that's a lower tax bracket, meaning lower tax rates. Not only are you paying less dollars in taxes, but you're also paying a lower tax rate because now your expenses are here instead of here. Then after your deductions, you also get the value of depreciation, which means you get to tell the IRS, hey, my property is a year older. It has wear and tear, and because of that, I deserve a tax write-off on my taxes. Even if your property is more valuable, even if you have no real physical wear and tear, you still get to write off this depreciation against your taxes, which means you get more money in your pocket while paying less money in taxes. Let me show you. Going back to this example that I gave you earlier, where I bought this property for $500,000, and assuming that I buy it all cash, I'm going to get $35,000 worth of profit. This is the cash in my bank account at the end of the year. Well, in residential real estate, so this is homes, single-family homes or duplexes, in this type of residential real estate, you get a 27.5-year straight-line depreciation. I'll explain what that means. That's what it is at the time of the recording, and for commercial buildings, it's 39-year straight-line depreciation. What that means now is you can take the value of the property, divide it by 27.5 years, and that's how much you can deduct from your income, from your profit every year over that 27.5 years, just because your property is older. So how do you do that? Well, let's assume now for this $500,000 property, $100,000 is the value of the land and $400,000 is the value of the building. You can't depreciate the value of the land, but you can depreciate the value of the building. So now you take this $400,000 and you're gonna divide it by 27.5, which equals about $14,500. This is how much you can write off from your taxes every year just because your property is 1 year older. So now I go to the IRS, I say, okay, I made $35,000, and we'll assume that I have no deductions for the purposes of this example. And now we get to subtract $14,500 from my taxes. Remember, I still have 35 grand in my bank account, but on my taxes, I'm gonna write off this $14,500, which means my taxable income is $20,500. Now again, I have $35,000 in my bank account to spend, but I'm gonna tell the IRS I'm only gonna pay taxes on this $20,500, which means not only do I have to pay less money in taxes, but again, lower tax bracket because I have less income. But this is where things get really fun, because what happens if I didn't buy this property all cash? What if I use debt, like I talked about earlier? Now, in this example, I'm only going to pay taxes on my $20,500, even though I made $35,000 of profit. But if I bought this property with a mortgage. Now remember, I only had a $7,000 profit. So $7,000 worth of profit, but then I get to deduct this $14,500. So now I subtract this $14,500 and I have this negative $7,500 loss. I tell the IRS, hey, I lost money. I have this $7,500 loss, even though I have the $7,000 in my pocket. I made $7,000 on a financial cash basis. But in terms of taxes, I showed the IRS that I lost $7,500. Now, what you could potentially do if you qualify with your income, this is not for everybody, but some people are then going to be able to take this loss and deduct it against their own income. Now, at the time of me recording this video, in order for you to be able to deduct this loss against your ordinary income, your income from your job, you have to be making under $100,000 a year. And after $100,000 a year, this deduction gets faded out up until $150,000 a year. And the maximum that you can deduct is $25,000 in 1 year. And you also have to prove that you're actively involved in real estate. You have to show that you are some sort of real estate professional with your real estate investment. So again, this is why you want to make sure you have a good accountant on your side to do this. But there are ways for you to deduct some of this income against your ordinary income, the money you make from your job. Now, this is where things get even more interesting, because what if now you make more money, you don't have a job? What can you do then? Well, you can also carry forward this loss into future years. So now if you make a profit in a future year, well, now you can say, well, in the previous year I had this big loss, and you can keep carrying forward this loss. You're making money, but you don't have to pay any taxes. And the third big tax break that you get is something called the 1031 exchange, which says that you can sell your real estate for a profit and not have to pay any money in taxes if you take your profits and buy another property. So let's jump back to this previous example. You buy this home for $500,000. Now let's assume you own this property for a number of years. It's paying you cash flow, but then you're able to sell this property for $1 million. Pretty good. You made $500,000 of profit. Now you're also going to have to pay taxes on this $500,000 worth of profit, right? Well, maybe. Normally you would, but with real estate, you get this 1031 exchange, which says, okay, you have this $500,000 worth of profit, which would be taxable, but if you take this $1 million and you invest all of it into a bigger property, well, now you don't have to pay any money in taxes today. And now you can keep flipping this real estate year after year after year. You have to hold the property for just longer than a year, so you can't do this in 6 months. This is why you have to be an actual real estate investor. And then you have to buy bigger properties. Now, if you do this until you die, you never have to pay any taxes on this. But if you keep doing this 1031 exchange, you don't have to pay any taxes on the profits of this property. Now, again, this is very tricky. There are many regulations on this, so make sure you have a good real estate accountant and a good real estate attorney that will help you do this. So don't just go and blindly do this and expect not to pay any money in taxes, because if you just do this and you do it wrong, not only are you going to pay taxes, you're also going to pay penalties and fines. So make sure you have a good team, a good real estate accountant, and a good real estate attorney. Now, this brings me to the second reason why people love investing their money in real estate, which has to do with saving hard money. Now, of course, if you are a real estate investor and you want to stay up to date on what's happening in terms of the real estate market and the stock market and crypto and our economy and the global economy, then if you haven't already, join Market Briefs. Market Briefs is a completely free resource that I created to help you stay up to date on what's happening in the financial markets. It's a daily financial newsletter that breaks down what's happening in all the financial markets into a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning. It's super easy to read. So even if you don't have a financial background, not only are you going to understand what's happening, but you're going to look forward to reading Market Briefs every morning. And the best part is it's completely free. So if you haven't joined Market Briefs yet, I'll put the link to how you can join Market Briefs down in the description below. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you gotta do is click that button right over there. Thank you for watching, and as always, keep hustling.